Well, welcome to the autumn series of WG Hub Live, and to those of you returning to listen from the summer, we're very pleased to welcome you back. Sorry, I'm still not fixed the coffee and pastries issue, but hopefully you're well settled in for an hour of presentation this morning. So many of the WG community have commented on the increased time they have spent working on their business this year, through, unfortunately, having additional time because trade was down, or in order that they get through the pandemic, they've had to reassess their strategic direction. So in this series, we're going to look at some financial strategies, both personal and business, that we hope you'll find both interesting and informative. So please interact. We have the chat function. We also have the question and answers. So put those in your Q&A box, and we'll deal with those in the second half of the event today. So we are recording these sessions, so if you do want to listen to this again, or if you want to share it with a friend or a colleague, then obviously you'll be able to go to the WG Hub Live webpage and see it all again. So today's panel members are private client and transaction tax expert, Mr. Matt McCullum from Ward Goodman. Good morning, Matt.
Hey, how you doing?
Hi, and we've got Director of Ward Goodman and Chartered Financial Planner, Mr. Alex Foster. Good morning, Alex.
Hi, all.
So without further ado, I'd like to welcome our main speaker for today, Justin Levine. Great to have you here today on WG Hub Live, Justin.
Thank you so much. I'm delighted to be invited by Ward Goodman to entertain you on the very dry and interesting topic of mergers and acquisitions. So if anybody suffers from insomnia, boom, we'll sort it this morning.
I know you. I know you're going to be more entertaining than people who would expect.
I do hope so. Do you want me to jump straight into it?
Yeah, if you don't mind, that would be fantastic. If you want to get your slides up, Justin, we'll let you go. And as I say, we'll get the Q&A session going once you're ready. Okay, over to you, Justin.
Can you see my slides is the question?
Yes.
Magic. Okay, so thanks again for Ward Goodman. Always very, bear me a second if I can get my slides to work. Always a challenge to talk to an audience without an audience, if that makes sense, talking to a computer screen. So I wanted to start with what is, I think, a fairly sobering statistic, that if you look at all the business brokers across the UK, the very large business brokers, and you account for all the companies that actually put a for sale sign above their business, metaphorically speaking, the question is how many of those companies go on to a successful sale? And the answer is it's between 5% and 30% of those companies, which means between 70% and 95% of all those companies that go to market fail to sell. It's a fairly astonishing statistic. It's also quite verifiable, by the way. So the question is, why are all those companies failing to sell? And of course, there's a lot of cost and time wrapped up in selling a business. Typically, it can take anything from sort of 6 months to 2 years to sell a company. And it's not like selling a house, because selling a house is you pay the money to the estate agent when the thing sells. But selling a company is that there's increasing and escalating, almost exponential costs as you go through a sale process. So if you put the sign up and you sell it and you don't sell at the end of it, you can be out of pocket to tens of thousands, sometimes hundreds of thousands of pounds, and sometimes even more if it's a large company. So what I want to do today is I want to give you some takeaway points, because this is not just about selling a company. Actually, there's some points in here, some hygiene factors for any business owner that I think are extremely relevant, whether you're thinking of selling or whether you're not. So the discussion is entitled The Art and Science of Successfully Selling a Business. There's a bit of science and there's a bit of art involved. And to understand how to sell that business successfully, we've first got to ask some questions. And the first one is, who is best placed to sell my business? You know, should you as a business owner sell the business yourself? Should you find somebody else to sell that organization? Question number one. Number two is, how can I aim for the best price? I mean, what is the best price and how can I make sure that I get it when I come time to exit? Question number three is, what do I need to prepare in readiness of that exit? Is there stuff I should be doing along the way? And that's particularly relevant for company owners that are thinking, well, I'm not ready to sell yet, and it could be 5 or 10 years downstream. And last but not least is, are there any pitfalls that I need to be aware of? And I'll give you a hint. The answer is yes, there are some pitfalls. So the first question is, why sell a company? Well, there's some very obvious reasons. Clearly, a business where the owners want to retire and there's no family succession. And as we go through the presentation, you'll see the kind of volume of businesses there are in this country. And there's a huge demographic that is happening from people that started businesses 40, 50 years ago that are aged 50 to 80, sometimes older. And that wave is like a tsunami coming through our time of period now, where for a lot of those businesses, there is no family succession. So, of course, the real opportunity is to cash out. And the important thing is that most businesses, when we all set up businesses, or people that I know that run organizations, people hope to draw a reasonable income from a business. So lots of business owners will reach a point that hopefully where they're drawing healthy salaries, healthy dividends, and develop a comfortable life. But actually, the real opportunity with an organization, if it's run well and positioned correctly, is the exit, because the exit can generate life-changing capital. So there are organizations, if you run a business and it sells for 5 to 50 million pounds, at the end of that process, it's a much bigger chunk of money than it has been with the money you've drawn out through the running of the organization. So, for some people that becomes quite appealing. There's also some very non-obvious reasons as well. And occasionally you'll find organizations where the shareholders will recognize that their skill set has got the business to a certain limit. And if you read business books, you'll see that businesses have thresholds. It's almost like a set of stairs where, from a revenue point of view, a business will get to £500,000 turnover, then 1, and then there'll be another chunk from 1 to 5 million, like stairs is, and literally drawing it out from 5 to 10. And those are big step changes in the organization in terms of the skills often required to run it. I'm generalizing, of course. Sometimes business owners recognize that they are on a level, they're on a stair, and that they don't have the skills to take the business further. And sometimes they'll go, listen, the business can grow beyond me and bigger. And of course, competition can get hard. I mean, it's not easy markets. I work across a range of different organizations over the past 10 years, and there is no grass and it is not green up the other side. Whatever an organization looks like, whether you know it, whether you read about it, open news, and you go, gosh, it's lucky for those guys, they're doing so well. The answer is there's competition everywhere. It's always hard in business. I wanted to set a definition really here, because it's important when we start to answer the questions that I posed, is why so many companies don't sell. And we need to understand to say, well, what do we mean by a company? So I've drawn this from, it's a government definition. And so for micro companies, typically is less than £1 million revenue, 0 to 9 employees. Small companies, from 1 to 10 million pound turnover, 10 to 49 employees, and then mid-sized companies from 10 million to 49 million, 249 employees, and large-sized companies, sort of 50 to 200 million. Now, I'm aware that, there are some large, I would call it accounting firms, organizations that have a different perspective on what a medium and large-sized companies is. But this is the one the government uses, and I think it's as good as anything. So, in terms of volume, if we were to look at the UK, the statistics are astonishing. There's 5.8 million companies, registered companies in the UK. And if you look at the curve, it's somebody called Margaret Thatcher. Some of you might have heard of her. And she's the one that really lit, I mean, business existed before she was around, but she lit the entrepreneurial sort of sort of firework, if that's right. And of course, she did some good things and bad things. Not going to get into politics. But the point being, if you look at the registration of limited companies over the past sort of since the 1980s, it's like a plane taking off, 5.8 million. But here's the point, 4.4 million of those companies have 0 employees. They are one-person businesses, so they are less than a micro enterprise, it's a sub-micro enterprise. So the vast proportion is a tiny organization, one person. And then of the micro companies up to £1 million turnover, there's 1.1 million of those. But you'll see with the numbers that we're starting to chunk down. Once we get down to a large-sized company, according to the Office of National Statistics, there's only 8,000 companies in the UK, large-sized companies. So the volume is dropping considerably as we get bigger and bigger sized organizations. I know some of you might be dialing in from a different region, from the Southwest. I couldn't help wave a bit of a flag. There might be people that actually know that originally I come from the Northwest. So the Southwest is just a nudge below the Northwest. But interesting, this is the number of private sector companies by region. I couldn't help, the slide is irrelevant to what I was talking about, but I was dead excited to wave the flag about just how positive a region the Southwest is in terms of number of private companies. So you can see here, the Southwest compared to, for example, Scotland, vast proportion more in terms of the Southwest. Very positive number. Listen, forgive me, not relevant to the presentation, couldn't help waving the flag. So the first thing, just as a recap, what we're seeing is that there's 5.8 million companies, but we've got 4.4 literally shell companies, that's one-person businesses. Then we've got 1.1 that are micro businesses. So when we start talking about how to facilitate an exit, in other words, what do I do when I come and I want to sell this business? Do I sell it myself, or can I find some other organization to do that for me? Is we start to see on this slide here that the non-employers, I call that the sub-micro enterprises, or indeed the micro businesses up to £1 million, the choices are incredibly limited. So we get, perhaps, obviously the COVID-19 period dropped our demand, but as an average, we get 2 to 3 phone calls a week from very small businesses turning over a few £100,000 up to £1 million saying, could you help us sell your business? And my response to them is to say they are very difficult to sell. Very difficult companies. And with the emphasis, that's not impossible. I'm not saying you cannot sell a small business like that. What I'm saying is they are very difficult to sell. But I think if you remember the slide, we've got, in terms of micro businesses here, there are 1.1 million of those companies in the UK. So of course, it's a sector where, if you were saying, who could sell my business? The national business brokers are very happy to target this sector and take fees from a small business to try and sell it. Invariably, they don't sell it. But the point being is they're very happy because they've taken their £10,000 to £50,000 retained fees, and they don't really, really care whether the business sells or not. And this starts to give a little bit of a hint to say, well, why are those numbers so high about the numbers of companies that don't sell? Well, the answer is because some business brokers will take these organizations on, even though they're really tricky to sell, and they'll just take those retained fees. Once we get to a small company up to 10 million turnover, and I have to say, maybe there's some business owners listening to this or might listen to it downstream and might say, dude, my company's not small. 10 million is not a small organization. And I would say, well, actually, in the grand scheme of things, if you're running a business at £1 billion or €1 billion turnover, a £10 million company is small. So it's just a definition, nothing to get emotionally attached to. But the options from a small, mid and large sized company are that you have a range of organizations that can step in and professionally help you sell your organization. So you can have business brokers all the way through to regional accountants with small businesses. And of course, with the large companies, investment banks start to wake up and smell the money. If you're selling a business turning over £500 million a year, boy, the investment banks, they'll get all of their Henrys and their Justins out of bed and go, hey, let's go and charge some big fees to sell the organization. I wanted to touch a little bit of this and try and give a sense from I sit as a daily activity selling companies and speaking to buyers across a wide range of different markets. And this slide here is to try and understand where the buyer-seller power sits. And when you have smaller organizations, I would argue that the buyers have the power in the relationship. And it's a generalized, I put a little note down the bottom right-hand corner, it's generalized. But what I mean by this is somebody will come to us. We had one 2 weeks ago, company turns over about £9.5 million a year, and it's got a long-standing business. The owners, really their perspective was, when we go to market, and of course there'll be much bigger organizations wanting to buy, they're typically bigger organizations that buy us. When we go to market, those buyers are going to jump through hoops, and it'll be a bun fight for my business because, boy, I've got such an exciting business. And actually the reality is, as a generalized rule, is that buyers see a lot of opportunity. So if we go and speak to a corporate buyer, even if it's a private enterprise or a PLC, as a potential buyer for an organization, they're seeing several opportunities a day, not a week, a day. So they're able to pick and choose. It's a bit like, I shouldn't do this because it's being recorded and my wife might watch it, she probably will. It's a bit like when I went to university when I was a young man. I went to Imperial College and there was 8 men for every 1 woman. Well, I didn't know this before I went, but it was, you could imagine going to the bars trying to get a kiss from the girls. You stood a 1 in 8 chance. The girls just had so much more opportunity to choose. And this is the same, really what I'm saying here is that if you've got a small organization, the buyers get to see lots of opportunities and can pick and choose. Occasionally, there's always the exceptions to the rule. However, the whole thing turns about when you get larger size companies. So once you get to 10 million plus size revenue, and especially once you get to 50 plus, the dynamic changes, and that is the buyers see much less opportunities, and that's because of the numbers, the sheer numbers. If you remember, there's a much smaller number of mid and large sized companies. So frankly speaking, a large sized company is very easy to sell. It's not a difficult thing to sell, but a smaller organization is tricky because there's lots of noise. Buyers see lots of noise, and to sell these businesses really needs sort of some process or individual that's able to cut through that noise to sell it, because the buyers see lots of opportunities. Just a general perspective. For those of you that are suffering from a massive dose of insomnia, and want to know, well, how do people go about valuing a business? And the answer is there's 4 key ways of doing this. And the first one is the EBITDA multiple. I call it EBITDA. Some people call it other stuff. I won't cover off what EBITDA means, but for those of you that haven't come across it, it's your operating profit, adding back depreciation, interest, etc. We can ask some questions if people want to ask questions later. What I mean by the EBITDA multiple is a business will generate a sustainable profit, and then the accountant or corporate finance team will calculate EBITDA, and the buyer will value that as a multiple. So as an example, let's say your business does £500,000 EBITDA. In the market multiple for your business might be 5. Therefore, the buyer would say your business is worth 5 times £500,000, £2.5 million. General rule. Second one, I won't go through, discounted cash flow. Number 3, revenue multiple, and number 4, net asset or book value. If sitting here, it's a very rare day when the valuation technique is not the EBITDA multiple. In other words, the first one is really the primary mechanism that most buyers use to value a business. And so this particular slide starts now to talk about where buyer appetite sits. So on the left-hand scale, we have EBITDA, and we've got 0. In fact, we've got a negative. And then we've got £500,000 halfway up, and then 1 million, and of course, that goes much further because businesses can generate more profit than that. So, and this slide, of course, shows a gradually increasing range of profit. And what you can see on the right-hand side, is ease of sale. From red is nigh on impossible, to green, which means happy days. It's dead easy to sell this business. And there's a general rule of thumb, and that is most buyers ask for a minimum £1 million EBITDA. So it's a bit like supermodels. The get out of bed fee for most buyers when they're looking for organisations is that the seller's organisation will do about £1 million EBITDA. It's not a black and white scenario because this is gradiated from red to green. And here we have amber in the middle. And of course, if a business is doing a £500,000 EBITDA, is it sellable? The answer is, of course, the answer is yes. But it actually, buyer interest drops off from £1 million to £500,000 quite considerably. In fact, some buyers simply won't look at targets regardless of how attractive they look. And then once we get sub £500,000, we start getting down to the area where it's quite difficult to sell an organisation. Now, I'll reiterate, there is an industry of organisations that are very happy to take fees to sell a company. And this, what I'm presenting, is actually something that you won't find publicly, as far as I can, as I've looked and seen, is that most advisors would simply take the fees from a seller and go, we're happy to sell it, even if your EBITDA is down about 250,000 happy days. What they won't do is say, it's going to be tricky to sell. They'll say, pay us the fees and we'll get cracking. And what this slide is starting to show is, when we go back to our original premise, which was between 70 and 95% don't sell, is the reason being is because a lot of those organisations are either very small or they're in the very low EBITDA range. Now, of course, as company owners or people that work in companies, I'm sure you'll be saying, wait, business that knocks out £250,000 profit every year, happy days. Yes, nice business. But what we're talking about is the process of going about and selling it. And so even if you're not selling your company, if you're thinking about it one day, what is a rule to employ? And that is profit. So if people ask me and saying, Justin, what is the one thing that I think I should focus on in terms of preparing a business, and one day I might sell it? And apart from intellectual property, I'll come back to that later, the answer is profit, EBITDA, profit, profit, profit. That is the key driver of revenue. You can have a business turning over £2 million a year with a £500,000 EBITDA, and that can be the same value in the market as a business turning over £40 million a year with £500,000 EBITDA. So it's profit, not revenue. So as this is really a general rule of thumb that I'm hopefully sharing with you, and it is, there are exceptions to the rule, and I really want to be mindful to give you that caveat. But if you were to say, where does the multiple of EBITDA sit in the marketplace? The answer is, as an average rule, so for a business that has what I call a differentiated offer, in other words, the product or the service is a little bit unique, a little bit special, there's a little bit of intellectual property in the business, you've got reasonable growth, probably average returns for the industry, but frankly speaking, you probably have a low market share. The average EBITDA multiple is sitting between 4 and 6 times EBITDA as a general rule of thumb. And it actually hasn't changed at the moment through the COVID-19 sort of crisis. We're not seeing those multiples, but we'll see what the stats show. If you were to say, well, how could it be lower? Well, the answer is, it could be from 1 to 4 if the business offers a commoditized offer. In other words, it's the same as everybody else's. You can buy this at this place, this place, this place. There's no IP and no intellectual property. The business has low growth or low returns. And probably with that kind of business, in terms of market share, there's no measurement. The shareholders or the owners don't measure it. Conversely, of course, people are not interested in this bit. They go, actually, how do I go this way and get from 6 to 10 plus? Well, the answer is, you've got to have a differentiated product or offer, a product or service. There's got to be some intellectual property. Intellectual property can be a very strong driver of valuation, as can strong growth, above average market returns, and either strong growth or a medium to high market share. EBITDA multiples can go above 10. So we have a client of ours that is positioning for sale, has a revenue of about 55 million, has a very strong position within the marketplace, and we're already looking at an EBITDA multiple of 10 plus. And that's before we've engaged private equity companies. So, I'm generalizing with this slide because you can have e-commerce businesses, pure play e-commerce businesses can command very high EBITDA multiples. Technology companies, medical devices, for example, healthcare market, anything that has intellectual property can have very strong valuations. So I don't want to be too blanket about it, but as a general rule, kind of stands okay, that slide. One slide I wanted to share was the value trap. And I suppose this is, I'm going to be a little bit critical of the industry that I sit in to a degree, is smaller companies from 1 to 10 million turnover, shareholders, as a general rule of thumb, probably something I've repeated a few times in this presentation, can have a disproportionately high expectation of the value of their organization. And it's weird because once you get to large companies, £200 million turnover, the owners or shareholders typically have a very realistic expectation of value, whereas a smaller organization can be disproportionate. I'm honestly of the view that this has been inflamed by the industry, the very large business brokers that exist in the UK. So a lot of them trade. In fact, their pitch decks when they go and see clients are all about the auction process and about how they can drive EBITDA multiples up and will sort of drive them north of industry averages and will achieve very high numbers. So there's one company I know of that says their average EBITDA multiple they achieve is 9. That's the average right across all the sales of their businesses. They sold 500 businesses. I don't personally believe it because there's a lot of statistics to say that that's just not correct. But of course, if you think about it, they're motivated to bring, because of course there's 1.1 million companies in this space. They're motivated to engage the smaller organizations to get those upfront fees. And that's a huge profit driver for them. So whether they sell the business or not, it doesn't matter. The fact that they're promising this wonderful EBITDA multiple and they've got this magic sauce is, to a larger degree, somewhat of an illusion. There is always elasticity in pricing. It can differ depending on the skill of the people selling it and the market appetite. But just as an overall view, smaller organizations often have a disproportionate idea of what businesses are worth. So if you're going to say, who's going to buy a business? Who goes out buying companies? Well, you can lump them into 2 lumps. It's quite easy. One is a strategic buyer. A strategic buyer is a trade buyer. That's all. It's a trade buyer. And the reason we call it strategic is because the buyer will have an aligned interest in the seller. So if I'm a business making window frames turning over £10 million a year, then a trade buyer probably is going to make window frames, but a much larger organization. And of course, the reason they're going to be interested is because of that wonderful thing called synergy. It's a horrible management word, but if they buy your business, potentially you can cross-sell the products. Maybe you can cut some costs out of the supply chain. There's financial benefits of a bigger company buying a smaller company in the same trade. And of course, you can have a regional company or a national and international company. For financial buyers, then there's a range of financial individuals or investors that will come along and buy a business. I think the first thing to state is a financial buyer is either an organization that simply just wants to take the money, full stop. So these individual investors here, for example, just simply want to buy a business and get a decent return. A bit like, investing in the housing market and buying houses to rent out. It's very emotionless. I want a certain return, a yield. That's why I do it. Some organizations, the private equity firms, they make their money 2 ways, actually. The first one is buying it at price X and selling it at price Y, the difference between profit. And the second way is by financial engineering, because most private equity companies will buy an organization and immediately get their money straight back out again through dividends based on leveraging or borrowing money, the company borrowing money. So it's financial engineering. Sir Philip Green, I believe, has somewhat of a PhD in financial engineering. Anyway, I would say too much on camera. We do have family offices, high net worth people that actually invest in organizations and buy them. And generally speaking, you can see here that from this phrase enterprise value, let's just say that your EBITDA value, 5 times your 500,000, 2.5 million, that's your enterprise value. From 2 up to 100 million is Generally, trade buyers are buying at this level, but the large private equity firms tend to look at much bigger transactions. But key messages, basically, trade buyers or financial buyers. That's it. That's the only people that can come and buy your organization. I don't want to focus too much on this slide. Actually, I just threw it in really from a best practice point of view. Any organization that goes about selling a business, it's not a difficult process actually from a complexity issue. But as you'd imagine, is that if you're going to do the job really, really properly, is you're always going to want to have a look and do some market research and look forensically at potential buyers. Buyers, by their nature, are changing all the time. So over the past 10 years, we've seen much more Chinese inward investment in the UK. So lots of Chinese companies. You might feel bad about it, good about it, but it's simply happening. And we're seeing a little bit less of mainland Europe sort of investing. But to go and find buyers, basically the right process is to go and look all over the world in the right kind of market. So any process is going to be looking a corporate finance house or a mergers and acquisitions boutique like ourselves. You'd want them to come into the business, understand it, and really fully understand what makes it special. To profile, to spend some time understanding who's going to pay the most amount of money for a business, who's going to buy it and not smash it with a mallet and move it, who's going to keep it and nurture the employees and, you know, basically take over the legacy that you've built. They're going to conduct that market research and look globally and not just reach into their sort of drawer and find a few names that they know are known buyers. They're going to want to start from scratch. The financial analysis is a very key part of this because any buyer wants to see what the business is going to make under their ownership, not yours. So you need to unpick your financials and represent them, looking at it from the buyer's point of view. And you need to project forward and say, well, if you buy it, what kind of synergy are they going to make? What kind of cost savings? What kind of uptick they're going to see in the sales? All that needs to be modeled in the financials. And of course, it all needs to be written up in a very compelling information memorandum that looks, quite frankly, sexy, looks professional, looks engaging. And you're going to want competent people selling your business. Very often as not in our industry, the market outreach, the negotiations are pushed down in the organizations to associates, to, frankly, they're well-educated but very unknowledgeable individuals. And it kind of shows in the quality of the negotiation. And of course, the last bit is we have what we call due diligence closing. But I don't want to labor too much, but that's what a great sales process would look like. And typically it would take a year. You know, anybody that says, well, we're kind of ready to go to market, from the starting point up here all the way through, you're looking 12 months to actually having the cash in your account. Okay, this is probably the most interesting slide, I think, being ready, aka the pitfalls. So if you remember at the beginning part of the presentation, I posted the theory that 70 to 94, it's not a theory, it's fact, 70 to 95% of companies don't sell. And I said, well, actually, partly it's because some large business brokers will take those small organizations on that they really shouldn't and don't guide them particularly well, but they'll take their fees. And number two is because a lot of those organizations simply don't have enough profit to get buyers excited. But there is a third part, and this is the part that's relevant for anybody listening that says, well, I don't want to sell my business. There's some things that go on in a company day by day, month by month, that need to be taken care of. So these are some of the things that really do trip projects we've had. So I'm speaking from experience. So in no particular order, share transactions, as a business go through its life cycle, typically a business might have different shareholders coming and going. You might have some founding shareholders, you might have people going. And the share transactions are a legal process. And they have to be handled in a particular way. It has to be done very, very accurately with a number of different steps that involves HMRC. And very often as not, I've come across, quite frankly, more than a handful of organizations that have handed this to perhaps an accounting partner, or they might have done it themselves. And when they come to sell, the buyer solicitors say, let's have a look at those share transactions that happened 10, 20 years ago, or 5 years ago, and sometimes say they're invalid. I know that you have a sale and purchase agreement. You have a document that shows money went from you to the shareholder, but sorry, buddy, legally speaking, it's invalid. And this can absolutely stop a deal dead in its tracks. It can be very, very difficult to unpick that. Sometimes it is possible, but sometimes it is not. Imagine you're selling a business for £10 million and you had a big shareholder that you bought out 5 years ago, and you have to go and phone that person up and saying, Kevin, I know I bought you shares for 50 quid, but we're just about to sell our business for 10 million quid. Could you just sign some papers that say that we did do the 50 quid properly? The conversation is a tricky one. So tax issues, IR35, for example, I put open or potential. A lot of organizations have structured themselves such that key people, directors, for example, consultants, take their income through service companies. So they're not on the payroll. They're trying to basically circumnavigate PAYE, national insurance contributions. And very often as not, they haven't been pinged by HMRC. But this is, from a buyer's point of view, they can open the books up and saying, listen, guys, what you've been doing is a breach of rules. And that can cause a real hiccup, as can, sort of being pinged by HMRC for big tax issues that really in the sale process. So having your tax issues looked at from a tax attorney point of view before or during the process of running your business is critical to get the I's dotted and the T's crossed. It's very important. This one here, weak management systems, inconsistent, and I kind of lump this together with a reliance on the bookkeeper, quasi-accountant. A lot of organizations, even medium-sized companies, have built themselves up with every year they run their business, they make their profit, ka-ching, they give their accounts to their accountant, Ward Goodman. Ward Goodman do the exemplary job. I'm looking at Ian here, do an exemplary job of totting those numbers up and doing the statutory accounts. There's your corporation tax bill. Let's file at a company's house, job done. Buyer comes along and actually says, okay, show me the systems you're running inside the business. And you go, well, we've got this bookkeeper over here, it's part qualified, and has been doing our data. But there's the buyer who's invariably bigger and invariably got a crack corporate finance and legal team, starts to look at it, says, yeah, but your management data here is not very strong. The systems you're using don't seem to be very robust. In other words, your monthly P&L doesn't seem to be quite accurate. The data that we can look at in that P&L doesn't seem to be quite matched up with what's shown in the statutory accounts. The reliance on a fairly low cost finance function when you're thinking about selling a business ain't good enough. It's just black and white. And I would highly recommend any company owner that says, if an exit's on plan one day, get a very strong financial presence, whether it's Ward Goodman, get them involved with the business and looking at that business for a period of at least 12 months before you go to market so that everything lines up. It can cost you a lot of money. I'm not saying it costs you a lot of money in hiring the cost, it can cost you a lot of money in not getting that piece right. One of the points that comes up time and again is the shareholder run big business. Again, I'm talking about small, occasional medium-sized businesses where the shareholders are still leading the company, and very often as not, they have not put in a management team. And it doesn't stop a company sale, but it can chip the price. It's far better to put a management team in place 12 to 18 months beforehand and have them up and running, even if you're not sidetracked, if you're positioned as the chairperson, chairwoman, chairman, for example, and you're coaching and bringing that team along, it's far better to have that in place to avoid chipping of the price. Things like no management incentivization. In other words, shareholder says we're selling the company, the management go, well, why should I stick around for that? It's always good to have a little think about that and make sure they're incentivized to get you to the end of the line. Inconsistent EBITDA, profit going up and down, frightens buyers, full stop. Full stop. And that is something that I would always argue to say EBITDA is either consistent, flat, or it's growing, but not lumpy. And frankly speaking, choosing the wrong advisory team. As we go on a little bit later in presentation, I do apologize for talking so long, but I'm going to keep an eye on the time, is choosing the right people to work with can be a deal breaker for you. And so I think we'll probably come on to that. So if you're going to sell your business, fairly dry bit this, but just to talk about it, there are 3 pools of people / organizations you're going to need to work with. Should you sell your company on your own? The answer is no, no, no. I would not sell our organisation, not that it's up for sale, we do get approached, but I would not sell it myself, even though that I consider myself a specialist in the area. I would give it to somebody else. Too emotionally attached. Never sell a business yourself. Get somebody to do it. In terms of an M&A, mergers and acquisitions, or corporate finance advisor, they find the buyer. I love that word, grooming. It's not very popular these days. They may help you groom the business and put a deal structure together, strike heads of terms, which is basically your sort of handshake agreement on how you're selling the business, for how much, and so on. And they'll coordinate all the advisors. We'll come on to sort of the different flavors of those companies. An accountant stroke tax specialist. When due diligence happens, when you sign a deal with a buyer to sell a business, the buyer will send in a team of people to do the due diligence. It's the inspection phase where they'll look through your organization and basically, like finding a needle in the haystack, they're looking for everything. And you're going to have a team to support that from your side. You'll need your accountant, like Ward Goodman, that is dealing with your accounts, that can help you answer the questions. And ideally, you have a tax specialist. And in particular these days, when you come to the end of this, the sale and purchase agreement, invariably there's some fairly thorny tax warranties and indemnities that come in a sale and purchase agreement. And you need specialists. You need specialists to support this. Otherwise, frankly, you're going into a process without the right kind of support. A commercial lawyer. There is a massive distinction between a general solicitor that deals with the conveyancing of a house, or might deal with a dispute with your neighbor because it keeps on cutting down your trees, and a commercial lawyer that deals with mergers and acquisitions. They're two human beings, but very, very different animals. And I would highly, highly advocate using organizations that are set up for handling this type of process. There's a totally different level of skill set involved. So the commercial lawyer will prepare the sale and purchase agreement, or indeed mark it up, and will negotiate that with the buyer's legal team. So 3 types of organization. So I just touch on this because this is more my area of expertise. When you look at who could support you in terms of selling a business, they come under different names. So you can have accounting firms, business brokers, business transfer agents, corporate finance firms, investment banks, M&A boutiques. We sit in the latter. And the essence of this is they all give a different level of service. So some, quite frankly, are relatively hands-off. Some are less involved. Some will not be particularly interested in doing lots of research for you. Some will hold the process all the way through to the end and be quite sort of specialist in guiding through the process. But basically, they come in very different flavors, different fees, and different skills. And it's very important that you find the right fit in terms of getting it to the end, because it's that 70 to 95%. And a certain proportion of that is down to the quality of the people that you engage. So thankfully, I've come to the end of the presentation pretty much. Just as a quick recap, we asked 4 questions. Who is best placed to sell my business? My personal view, of course I'm biased, is that don't sell it yourself, get somebody else to do it for you. It's a profession and there's a lot of specialism involved in that, but choose the right people. How can you aim for the best price? What do I need to prepare in readiness? Well, the first thing is to get best price. Clearly, hopefully you've got as a takeaway, you need to be showing an EBITDA north of £500,000. That's ideally. Anything less than that, and we're in the amber territory of buyer interest. Unless you've got something special, some special IP, or it's a pure play e-commerce business, and so on. So EBITDA, profit, profit, profit. What do I need to do to prepare in readiness of exit is linked to the last one, and that is, as you go through the process of running your business, make sure you're investing in your finance function, that it's really a best-in-class finance capability, and that even if you don't need it, get it, invest in it, because once you get to the end, it's going to help you at the end of that process. And there's lots of pitfalls. Make sure you've got the right people supporting you in terms of avoiding I didn't do the share transaction properly, even though I paid the guy. So lots of different pitfalls. Hopefully it's giving you a little bit of flavor of this wonderful esoteric world of mergers and acquisitions that I live in. So I will thank you for I hope I haven't put too many people to sleep. That's the end of my presentation. Thank you. Any questions, Ian?
Right, thanks very much, Justin. That was terrific. Obviously, you're a specialist in your field. We didn't quite get your introduction in earlier. But if you were to say, what key part you play when somebody wants to sell a business, could you do that in a sentence?
Yeah, well, I think probably I say this comes across negative. I'm a square peg in a round hole here. I mean, we've had this discussion. When you look at people doing this type of work, you've typically got either an investment bank or corporate financier moves to M&A, doing what we do. And I didn't. I spent 20 years running companies from small to extremely large in terms of numbers of people, and helped build those businesses by acquisitions and divestments. So I think at last count in my mid-30s, we had a 4,000 strong, 250 million euro turnover business. So the reason that I mention that is it's a bit bragging, I suppose, but it's a long time ago now, is I understand that the bit that actually we do that other organizations don't do is we spend a lot more time up front trying to understand the business. So we invest that time. It's often days goes on where we spend time on site with clients, really getting underneath the business so that we understand fundamentally how the business makes its money, where it delivers value. And I think that's extremely important, because if you remember on that slide where we're taking, most of our transactions are relatively modest, 3, 4, 5, 8 million. That's the kind of low end. But when you're taking these businesses out, the buyers see too many of these things. So if you're in a position, and that's where we try to position ourselves, where we're properly insightful on our client's business, and we do the research with our researchers, we know how to fit our selling businesses into the buying businesses and explain to them how they can make more money out of this. And because we invested the time with our clients up front, we score much highly in terms of selling these organizations. That's really, I think, in a very long sentence, what we do.
Great, thanks, Justin. That's terrific. I think we've got a bit of an overriding sort of question out there about what's going on at the moment. We're obviously seeing some movement in the market, and we're obviously seeing it in terms of people wanting to prepare for the future and for change, for restructuring, for buying, for selling. We are seeing that change. And I was actually just going to ask Alex about the trends that we're seeing in family business and family investors and what they're looking for. Can you just give us a little insight into what's happening at the minute, Alex?
Yeah, I think one of the words you used is restructure, which is probably quite poignant at the moment. A lot of families and family companies have dividend yields that they've been used to. We've seen those drop away in the investment markets at the moment. We've seen properties, sadly, people wanting rent deferrals or rent reviews or becoming vacant. So a lot of the families and family companies are looking to diversify their portfolios. And some of the aspects that they're looking to do is either sell off businesses that they don't feel they've got control of, or look to purchase businesses where they can actually control the dividend and the income flow to themselves and not rely so much on the property rentals or the dividends. So yeah, there is a bit of a shift in the market. And another aspect, which is why family companies are starting to look more to trading companies, is because some of them may have larger property portfolios, they're starting to fall foul of their inheritance and whether or not they qualify for business relief, and they're able to pass it down to the next generations free of inheritance tax. So you're right, the restructure, there's loads of different reasons, whether it's an income need, an inheritance tax, or just a general tax planning process that they're trying to mitigate. Yeah, there's a lot of change out there.
Yeah, no, I mean, we've got a question actually. Do you think that people are planning a bit more? We've got a question here. Do entrepreneurs put enough focus on an exit strategy from day one when they start a business, or is it just sort of a bit of an afterthought? And just wondering whether what you're thinking.
Yeah, it probably sounds really negative, and it's not meant to be. Entrepreneurs are very driven. They're very focused. I would probably say the ones that I know and meet may not be looking at the exit strategy because they're fully engaged with what they're actually doing. And that leads on to what Justin says. Having professionals support you throughout the process just helps you keep a little bit more on track, not to what entrepreneurs are doing today, but why they're actually doing it in the future. So no, I don't think they're always looking at the exit strategy. They're driven by passion more often than not the necessity to just make loads and loads of money at the end.
Yeah.
Can I just jump up slightly if I'm still live on this thing?
Yeah.
My dear friend Alex, I'm going to give you a slightly different view actually, and I'm going to use my Boris Johnson sort of gestures. Been practicing these. So I work at a business incubator at Kingston Business School, and you see people coming through, really smart young people. I mean, really smart, that have got business ideas, and they are setting these businesses up and getting seed backing, venture capital backing, and these 21 and 22-year-olds are all they talk about is the exit. And it's astonishing to watch actually, because actually there's kind of like almost different ends of the spectrum, because you've got these young people that are super smart coming up with ideas, raising money, sometimes serious money, and they're already thinking about the exit point, partly for financial reasons, partly the scale, because they've been taught this model about, you know, your seed fundraising, your ABC, your private equity exit route. And then you've got the other end of the spectrum, which is your older business owners that are in their 60s, 70s, or 80s, that for them, life's going to carry on forever. They have no idea about exit planning. And in fact, actually, I think, Ian, we know some people, you know, that we obviously privately, that, you know, should be thinking about an exit for very just practical reasons, you know, but simply just want to soldier on because that's their life. They're 70 years of age and they're working in the business and they've got nothing else to do. So it's you've got these two different ends of the spectrum. I'm not sure which one's right.
No, absolutely. I don't think there is I'm not sure that there is a right answer. I think what we do understand though is that, like you say, a lot of people are coming into business now, have had a lot more education, maybe about the way businesses actually work, and you know how they and it's not necessarily their experience. They're just expecting the business to go that way, and I think there's always going to be some surprises along the way, which trigger off events. Yeah. So I've got some. Obviously, I'd like to get through some questions. We haven't got that long, but I think we've got some questions about the EBITDA that you pulled up on quite early on in the presentation and reiterated it later. Yeah. Got a question here from Rob. Is EBITDA still used if a company is growing at 30 to 50% per year in revenue, or would it be based on revenue?
Yeah, so it's a good question. So there are exceptions to the rules, and Rob, you've asked one of the key questions, and that is when you have a high growth vehicle, typically it's e-commerce or a digital platform, SaaS, software as a service, could be examples of that. Is typically the buyers would do two different types of calculation: revenue and EBITDA, and very often as not, it would be the revenue multiple that would apply, but they would do both and maybe sort of try to sensitize or normalize where that line might sit. But you know, listen, high growth businesses are very, very attractive in the marketplace, full stop. You know, it's so revenue does play its part, and that's an example. So technology, pure play e-commerce, very fast growing businesses. Typically, if the business is a low EBITDA but it can get market share, then yes, revenue is kind of the key driver of the valuation. Right.
Yeah. Okay. So, like you say, lots of factors come into that valuation. As we know, valuation is an art, not necessarily a science. And our team, Matt's here. He works as a lot on our valuation work, and like I say, we know all the factors there that you have to bring into play. So I think we've got another question though about remuneration and the part that plays in a business. So how people are paid and how that's recognised when you buy and sell a business. So I've been approached to sell, and as my core remuneration is dividend for tax purposes, the buyer asked me for an adjusted profit to recognise my dividend as a salary. Is that typical?
Yes, it is, because the buyer is going to look at a business and look at the profit when he or she has bought that business. So a lot of business owners take their compensation out with a very small amount of salary and a chunky dividend. And of course, the dividend sits in the balance sheet, not the P&L. So it's very legitimate for a buyer to ask that. And unfortunately, there's no defense we can sort of put up as corporate finance people to say no. So the answer is yes. Typically, what I call a market rate cost for an individual of your expertise would be put back into the P&L to reflect. It'd either be your dividend put straight back in plus social costs to mirror a salary, or it would be a market rate salary put back in place. But the answer is yeah, I'm afraid it is. And this is one of the misconceptions a lot of sellers have, is that you can have a very profitable business, and when you sit down and have a conversation, say, yeah, but you have to add back, as managing director or chief executive, we're adding back a six-figure number to that profit, and it reduces that number. And it can come as quite a shock. So the answer is you've got to have that in mind, that cost needs to be replaced, usually.
Yeah, absolutely. So we obviously saw some changes in tax rates on the disposal of business. Well, was entrepreneurs relief, we've got business asset disposal relief. So here we go. So how do you think the sneaky dramatic reduction on entrepreneurs relief in March will affect M&A? It looks like it will. I think there's probably some expletives in there. Cost me an absolute fortune. Makes me think of not selling for another 12 months to make up for the extra I will have to pay. So can I just get Matt just to talk about the tax rates on the disposal of shares?
Yeah. So obviously, you're probably aware that the change, or the 10 million threshold has been reduced to 1 million, and there's talk or potential talk that it could be removed, but obviously, depending on what HMRC do, no one knows just yet. But entrepreneurs relief, providing that the business does qualify, or business asset disposal relief, providing it does qualify, will be 10%. Holding it for the company trading for at least 2 years, have 5% of the shares, the voting rights, and so on. Providing it does meet that criteria, then it would be taxed at 10%. Obviously 10 or 20% for anything else after that, but depending on your income rate bands and things like that. So 10% providing it qualifies.
Right. So the devil's still in the detail there a bit, isn't it, Matt? Because there's quite a few conditions, like you mentioned there, a few things about how. Yeah,
definitely. It's always worth getting someone to have a look to make sure you meet that criteria, because you don't want to understand or think that you understand. I'm going to be paying tax at 10%, or I specifically qualify for that relief, and then you don't, and then obviously you're hit with a very large tax bill. So it's always worth getting someone's advice.
Yeah, no, that's great. I mean, there are some basic industries that don't qualify, aren't there? So, you've always got to take that to start with. And but I think what we have said, the question here is, do I not sell for another 12 months to make up the difference? I mean, we do know of cases where people have delayed basically because they believe their business is actually going to do better, or has actually done better in the last 12 months. And we've actually seen that in quite a few cases, that actually if they had sold, they would have actually not got such a big number. So it could be that if your business is outperforming perhaps the general market, that by delaying, you could actually end up with a bigger number, even though you're taxed on it. And I think But I think I'm right here, Justin, in saying let's not let the tax tail wag the business dog in this direction. If you've got an opportunity, think about it.
It's a very difficult. I mean, this is where speculation comes into it. I mean, the obvious thing is that Sunak is posturing that more tax is going to come out of the wealthy, and unfortunately, capital gains tax seems to be in the crosshairs. So, I mean, if you were to sort of try and look in your sort of crystal ball, you'd say tax rates probably going to go up in foreseeable future. In other words, it's not a question of waiting now, because of course I think it was the Labour government that brought in the entrepreneurial relief, entrepreneurs sort of the 10% rate. So I don't think there's going to be some magic wand that happens where taxes go up and then they come down again in 2 or 3 years. In other words, I think as a general view, it's just my observation, I think taxes unfortunately is going to go up given the scenario we're sitting in. I think in terms of selling now versus selling later, the way that you can structure the consideration can take advantage of both, actually. So you can take an initial consideration that locks in your tax rate right now. And if you're confident about your business and actually you want to stick around, you know, personally downstream, then you can structure a deferred consideration or earnouts or such like. So to lock in, you know, basically to lock that initial chunk, take initial chips off the table, and then basically, you know, get further compensation downstream. And, you know, so some sellers are very wary of doing that, thinking that buyers will just simply manipulate their businesses and not allow those deferred. But there's ways to structure these things to make it fair, reasonable, and equitable. So I'm not seeing anybody make a decision in the marketplace based solely on tax, I have to say.
But I think together we've addressed some situations as well where there was this no money down situation. I know it's in the Q that we've actually got somebody in the chat box talking about, that's Rob actually, so talking about these no money down deals, you know, where there's nothing up front. I think that's what you're talking about anyway. That
let me cut across you. I know exactly what you're talking about. And the answer is no. I mean, if you've got a business that's worth £10 million in the marketplace and you take, let's say, 7 million off the table as initial consideration today, you lock in your first million at 10%, then you might have that 3 million balance. So you have 7 million cash up front and 3 million deferred over a period of time in one form or another. You know, there's different ways you can structure these things. Might be more attractive. But what you're talking about, Ian, is there's a phrase that's come up in our industry. They call them £1 Charlies. There is a massive industry, or growing industry, but it's quite big, of people that purport to be very successful in investing in businesses by buying a company, for no money up front. It's legally possible. We don't get involved in this market. This is, I personally view it as being somewhat of a scam, because it basically is, as a buyer, you're phoning sellers up and saying, I want to buy your business, and you're basically giving nothing for it and letting the company pay the owners back over a long period of time and raising debt to pay it. And it's just, I think it's quite immoral. I don't mind saying it on camera and on record, it's immoral. So, you know, my view to anybody that's listening to us, if you're approached by anybody that purports to be a wealthy individual or to represent a private equity fund, be highly skeptical as a starting point. Full stop. Highly skeptical. Almost all of them have no money behind them. So just be very careful, friends.
Oh, well, yeah, no, absolutely. And I think that it's the importance here to have, you know, a good team behind you, you know, and to really plan what you're doing. I think we're talking about this here. Think about in advance what you're doing. Get some good people involved. Get a good team around you. Don't try and do it yourself. And that's the way to really make the most of your business, really. The one potential time where you might land that big sum of money, or, you know, be able to move on and do something else. So, well, I think guys, I think that's as much time as we got this morning. So I'd just like to thank you so much, Justin, for coming on today and presenting. You've done a great job.
Thank you. Well, the gin and tonic, it went down a treat, and you got the results that it deserved. I'm joking.
Yeah, no, I think we'll probably all need a drink after that, won't we? But thanks, Alex, for coming on. Alex Foster, everybody. Obviously, you know, we look after a lot of people's money after they've exited their businesses. And so Alex is always happy to talk to you about your plans and where you might like to go next. And thank you, Matt, for coming on and just answering that little tax question there. So next week, I'm delighted to say that we have Mandy Fitzmaurice of Purple HR back again to update everybody on the latest COVID-19 support. As you know, it's been changing daily. So I think I'm just going to wish her good luck that the day before, or, you know, the morning before even, she might have the right information for us. She's going to provide, you know, some information on for employers on how to provide some HR strategies to help organisations move forward. So please book in for this event in the usual way, through email, through social media, the website, etc. So from all of us at WG Hub Live, thank you for joining us this morning, and we look forward to seeing you same time, same place next week.